Carl, this is probably the time that you'd start to try to pick winners from losers because, as you know, as sort of as a cohort, a lot of these stocks in 2021 had super normal demand and they became very popular. So you had a combination of both much better earnings plus huge multiple expansion. And now a lot of these are broken charts. So if an investor does their homework, I do think you're going to find some real gems that can compound at earnings growth. And if you don't have much multiple compression, these are going to be great long-term winners.
Examples.
Uh, I mean, for instance, I would say companies like Shopify, for instance, which have really been structurally really changed the economy, right? Because they've made it easier for merchants to do business. I mean, these are companies that are going to have permanent benefit in the future, but they've had to correct. So I mean, that's a name that comes to mind. And I mean, I don't know the valuation of companies like Zoom, so I don't really look at these names that carefully. But it's part of the everyday lexicon, so it is something that has traction beyond the pandemic. So I think investors have to do their own homework because it is sort of like sifting through rubble.
Yeah, and I mean, Peloton and its massive re-rating showed us that companies that pitched themselves as tech companies during the pandemic, they may have gotten that valuation at one point or another, but haven't lived up to it. And I wonder, do you think that there are any other sort of industries that could see that re-rating as well? Something that comes to mind maybe is ride sharing, but it hasn't run up at all really during the pandemic. But do you think that it's having more trouble showing that it has a real tech component?
Yeah, I mean, ride sharing is a good example, like the Lyfts and Ubers. I think it's really probably a question for investors about how they allocate capital and their margin structure. But, is the demand for the services strong? Yeah, it's clear. And they've actually, they've had an impact on how people basically move around and get food delivered and how they think about their lives. And it has also created essentially a gig economy. But again, it's really, for me in 2022, in a year where it's transitioning, it's probably easier for investors to find structural growth, and then where multiples are reasonable. That's really where you're going to see some potential for expansion. And like for instance, I think even the FANG complex itself looks pretty reasonable.
Tom, we've been talking about broken charts a little bit. What about broken business models? I mean, Peloton is in an interesting case where it saw this massive pull forward of demand, it seems, and then layered on a whole bunch of costs that are now not appropriate. So it's particularly broken looking. But is there anything else like that you see now, or anything that you think might end up looking more like that as things continue to play out?
That's a great question. I mean, like when you have hardware and service, it reminds me of the wireless industry. And as you know, like when you look at wireless, maybe two companies were able to sell hardware and service and actually make margin on both the hardware and the service. It was BlackBerry and Apple, and everybody else lost money. So you either had to choose to be a service provider, or you had to become a middleware company like the tower industry, which had great returns. So I just think, anyone who is trying to recast something that is traditionally a cyclical business or has, as you're talking about, very heavy items that need movement, these aren't really tech-like businesses or asset-light, as you guys talked about. And unless you can charge more money with inflation, an asset-heavy business would work better. So for instance, I mean, that's kind of why the market is favoring things like financials and energy right now, because as you have inflation, their earnings actually track the inflation. But, if you're selling equipment, I mean, industrial is the reason we're neutral. Industrial and probably parts of, asset intensive tech, they're a little more challenged because unless you can pass on those price increases, you're really talking about margin pressure.
Yeah. Hey, finally, Tom, you've done so much good high-frequency work on COVID, and you did mention this week, you said it's not a forecast, but you looked at the average duration of the cycle in which various variants occur, and you said it might suggest that we could get, if we're going to get another variant, could happen in April. How are you using that thesis, I guess, as a play on some of these stay-at-home names?
It's a good point, Carl, because if we look at the four drawdowns, the big drawdowns for equities, They did coincide with surges in hospitalizations and surges in cases. And we know that credit card spending took a hit big time with Delta and Omicron. So if a variant does emerge in April, and that's not a forecast, as we were pointing out, it's just really looking at the same interval of the last 4 variants, we can expect consumers to potentially be disappointed. And so we could see spending dip. And I think it would sort of bring back into favor a lot of these 2020 stay-at-home names.
Yeah, we're going to hope this cycle's different. We're just going to have to wait and see on that one, Tom. Good to see you. Thanks so much, Tom Lee.
Yeah, great to see you. Thanks.
Meanwhile, we're getting